Highlight midweek. Here's what we got. Combination of a couple things that are important. And I'm going to spell them out for you right now as far as the order flow with a pattern. All right. Order flow with a chart pattern. And what's unique about this, it's a chart pattern of another market. So if you trade the S&P E-minis, which is charted with these charts down in here, all right, order flow is a combination of what we watch are big buyers and sellers. And you see that, it looks really noisy in here because it's slow, but you see that with red boxes, all right, big sellers. Now, this isn't the moment where where this highlight took place. This was about 8:35 Central. And same concept, same thing happened. There was some selling at potentially the bottom of a move. What do I mean by that? If the market's going down, you don't know it's the bottom until after it rallies. Then you could say that's a bottom. But as traders, we have to read the real time to predict if this is a bottom, what do we want to see down there to qualify opening a long position? Well, one thing is selling. And you might say, well, why selling? Selling makes things go down. You're right. But what if you see selling and it doesn't make things go down? That's the key. So that's one question you ask when you see it. You got to be able to see it. You got to know what question to ask. Another thing is, and this is a lot more unique than most people will watch, and it went away right now, but when you get a green bar to stick out, you kind of seen it right there, and you've seen it when I started this video, and it just went away after a few minutes, it goes away. But when you're potentially at the bottom of a move, okay, and you're anticipating it going up, what do you want to see when you're about to get long? Do you want to see more longs or less longs? If you just answer with intuition, you might want to see more longs. You want to see, hey, more the merrier. You want to see less longs. The reason why you want to see less longs is because when you're long and when someone else is long and when that other person's long, they are sellers. Where do you want to sell it when you're long? Higher. That's why you're getting long. More longs, more sellers. So you actually want less longs, then you have less sellers. If you have less sellers, price has a better chance of going up. So when this is a green bar over here, it's indicative of longs getting shook out. You ever get shook out of a trade? If you answer no, then you're either lying or you never traded. We always get shook out of trades. It's what a market has to do. It's not always because it doesn't like you, and don't take it personal. It's a function of a market in order for it to exist, in order for it to be efficient, in order for it to accurately discover prices. So when longs get shook out, it's because maybe they were weaker or whatever, but it's important to know when that particular instance might be taking place, because that's going to qualify and highlight a better entry for your bullish long bias. Keep it simple. So that's the order flow portion of this thought process that we had at about 8:36 this morning Central Time. The pattern was in the NASDAQ. The NASDAQ, listen, you don't have to trade the NASDAQ to watch the NASDAQ. The NASDAQ is 100 tech stocks that make it up, and it's obviously going to correlate with the S&P E-minis and the Dow and the Russell. They're all stock indexes. The Euro stocks and DAX in Europe, they have a big move. It's going to affect U.S. and vice versa. So here's the NASDAQ at the time we're talking about was about 6 minutes after the open, which takes us right in here. And I had said, this looks like a head fake. Take a look at this. The market's, first of all, got weak, and you're looking for the NASDAQ to rally. You're looking for the NASDAQ not to rally because it could be too late, for the NASDAQ to have a chance to rally and follow through if you open a long position in the ES. So when there's a head fake pattern, a head fake HF, in a market that you want to go up, and the head fake means what? It fakes lower to go higher, or it fakes higher to go lower. This case, we want to see it fake lower to go higher. And generally, it sneaks out the bottom of something and then jumps back into that box. So let me just go forward. Look in the bottom right of the screen. Take a look at it sneaking out the bottom. It's a few minutes later. I think it was like 8:35. It's not even in there, sticking out the bottom. It was a little before that. They went after these 65s, and then They didn't get really out of the bottom of this. I think it was this bottom that they take out. And we just go slowly but surely. And you see it right in there. See this box that formed right here? And it snuck out the bottom and then quickly came back up to and through the middle. I don't know that it's going to go all the way up to there. But I do know, and we do say, that it has a chance, and a better chance than 5-10 seconds ago when you see this pattern. And you could say, what pattern? Because most people don't learn this early enough in their training. Here's the pattern. The box sets up in here. We're going down. No, we're not. And the no, we're not, if a chart could talk, is a chance that the market just threw out a head fake lower to go higher. There's details as to why this is an important pattern to watch, the details as to why it works. And remember, you're never going to do anything with any consistency unless you know why it works. Unless you know, and if you don't know the dynamic of a market, you're not going to know why. You're not going to know why to any question. The dynamic to a market is after you buy it, you're a seller. After you sell it, you're a buyer. And when people hear that phrase, they're like, wow, I never heard of that. But think of how much it exists. After you buy it to get long, you're a seller to get out. So is everybody else. Too many longs, too many sellers, hard for price to go up. Got to shake out if it's going to go up. That's all markets do. It's a shakeout fest. And that's why when people buy it late, they get punished. You have to know where you're at on the map, which means location. You have to coordinate your analysis by looking at a couple other markets. You have to allow what you're recognizing to make your decisions, not emotions, because those will make poorer decisions when your emotions are the ones making it, number one. And number two, you're not in a position to be consistent when you're making emotional decisions too much. You got to have something give you kind of a progression. If you're emotional when you're hunting and about to fire a gun, you're probably not going to hit the target often. You're probably not going to see the target often. So you have to have like a systematic approach, a ready, aim, fire approach, and that progression in anything you do. And most people can't articulate that. And a good friend of mine, Ken Packard at Daniels Trading, he says, if you can't articulate something, it does not exist. So a lot of people want to be able to do this. They want to execute their idea, but they can't articulate it well. And then if they can't articulate it well, it's a crappy idea because it doesn't include the dynamics that are important, like shaking out other sides, asking the right question when it comes to reading order flow. So it's really important. You often, if you watch enough of my videos, to find the overlap of important circles of skill, and you want to have this circle of skill always involved. And that's the one of having a kind of a clear understanding. You don't want to be too robotic, but you can't be too emotional. That sweet spot of having a steely approach doesn't mean you're not going to have butterflies. But you get out on that mound and you're competitive without being emotional. Have a safe rest of the session, guys. Good luck. If you're watching this on YouTube, make sure you subscribe.